Good morning, everyone. Thank you for attending and taking the time out of your day today. We've got an exciting lineup of individuals speaking today, but also content. We're going to be talking about the overall general nature of the economy, how it's affected the annuity and life insurance products and the guarantee rates and the development of those products, how it's affected them directly, but also in ways that you may have not thought of. And we've got I couldn't think of anybody else better to help me with that conversation than the leader of American Life, Tom Bumbolow, member of his staff, as well as Chris Coyne from Goldman Sachs. So we'll be introducing them in a second. And I'd like to first start off because we have a mix on the audience of new people that are viewing IAMS for the first time, those who have been viewing us for maybe a couple weeks or a month or so or a year, and those that are already have joined us. So I want to cover a couple things that will be pertinent to both and all three audiences in this case. We'll jump right into it. If you are new with us, we have a program you may be aware of. If you're not, make sure to ask your primary contact or marketer, development director at IAMS, or call me, Justin Ford. But this is our new producer builder program. Essentially what we're looking to accomplish here is when you come on board with us, we'd like to incentivize you to write business and submit your first cases as soon as possible. And the reason for that is obviously twofold. We want the business. We'd like to have you on part of our client journey, but it's important to get on the client journey too. If you're joining a new IMO, the sooner you put the rubber meets the road is the sooner you're going to start seeing exactly how things work. So will it work out for you? Will we work out for you the way that you expect? I would like to think so, and and vice versa. So the sooner you get those in, we're going to incentivize you. And the way it works is based off of production. Each one of these numbers up here, these are the annuity production numbers, and that's a mixture of annuity and target premium for life insurance. Single premium life pays as well at a higher level. But generally how it works, first 180 days with IAMS being contracted, you submit $100,000 of total premium, multiple apps or one for annuities, and that would get you a 1,500-piece postcard mailing or a choice between cash of $750 or an iPad or even a pre-formatted email and marketing analysis and corporate identity package, which is a big way of saying making you visually look as good as your clients already know you are in your community. And that goes all the way up to the $1 million level, submitting new business of $1 million. I've got a gentleman I'm working with now. How that works is a perfect example. He's within $100,000 or so of a new case of hitting this level, and we've already got his seminar invitations and everything ready to go to cover his next event. So, new producer bonus program. Ask us about it if you have questions. In addition to that, people like yourself that are new with us may have come to us via a referral. Surprisingly enough, our business is not that much difference, even though our audience is retail advisors versus retail clients. But we do have a referral bonus program. We're going to pay you for the referral, and we get referrals. We do appreciate it, and thank you for those of you, I'm sure, on the call that have referred people over to us. The other way we get referrals is paying for them, and so the way we do that is we pay you. And the way this will work is you refer someone over. I'm going to cut you a $50 one-time bonus check that you'll receive in cash. Then beyond that point, once that new individual is licensed, my team will take care of all the setup and getting them licensed. They're going to earn the full, their full commission as a general agent with IAMS. And in addition to that, you are going to get paid the following percentages on their business into perpetuity with IAMS. So that comes out of our pocket for the referral. And you can see there the numbers can add up quickly as you refer more people because you're receiving a live basis point, 20 basis points or 0.20%, on indexed annuity premium. So let us know if you have any questions on the referral bonus program. Our back office support, as you do start doing new business with us here, one of our primary, if we had to list out three of the primary reasons why agents do business with IAMS, the first of which is typically our service. Usually the answer is service. Excellent service over the last, since the late 80s, and our team continues to serve up the best. You can access this 24 hours a day on our website and also in person when you're working cases with our case management teams for annuities, life, long-term care, senior business. Offline or online, you can actually see everything applications. You can pull full applications from any carrier off our website, in-force forms as well, income starting rider forms, etc. Always accessible. You can quote term insurance and take the application right there from our companies using IGO, take an annuity application with a client, get it paid faster with less than 1% error, not in good order cases, as well as see information on products like annuities and life. Firelight is who we use for the majority of our e-application programs if a carrier does not have a proprietary system, and you can do those annuity applications via our website as well, constantly adding new carriers onto that list. As we're going to talk today, the pricing environment definitely has brought up some new products, which is more of a reason for us to take a look and do our due diligence. And our website, you can do a lot of that research on your own. If you haven't checked it out already, let us know. If you prefer to watch a webinar, our YouTube site has a webinar that Beth Rickliffs just recently did on navigating our website, which would be a great one to check out. I would say it'd pop up on the screen here, but I haven't gotten that advanced yet. But check that one out when you get a chance, or give us a call, and we'd be happy to do a walkthrough. I imagine there are several areas of our website that you didn't even know were there and that you didn't even know you needed. So happy to help if you get a question on that or have a question. Agency solutions. So our creative marketing team, we have an in-house advertising team. These individual employees are not a third-party advertising team that we pay a consulting fee to. Rather, we prefer to pay their entire employee benefits package and have them as part of and add to and enhance our culture. So these are employees with IAMS. Reason I say that and why it's important. With a advertising agency, there is an agreement that oftentimes we fill out as independent business owners working with a local PR firm, and the material they design for us may be the rights of that advertising agency. And as they begin, as you teach them how our insurance and financial services world works, and they start to get a grasp on it, they oftentimes will talk to other advisors, and that's great, using some of the same thought process they learned from you. Problem is that takes time, and none of us are guinea pigs. So our hope there is our creative team understands our business down to the niche that we're in. They understand the agent world, websites. We have examples. Love to do a consult with you on your marketing plan. So if you have interest in anything, whether it be a small business card design or an overall marketing and digital enhancement to your practice, talk to your primary contact here about getting a marketing analysis done on your practice. That's where we sit down, ask you a series of questions, and take that back to our creative team, and they take a look at it from a digital and all marketing, branding, front-end marketing, prospecting funnel standpoint. We get back with you and we go through everything that we found and recommendations we may have. IAMS Wealth Management. Those of you in the room that have your Series 65, or you're considering opening up your U10 and getting your 65, we have a corporate RIA. IAMS Wealth Management is a FIA and fixed friendly wealth management team, lower fees than many. Platform matches up because we do annuities very well between your managed accounts. And I urge you, if you have interest, to reach out to us. We can get a call going with Duncan to answer any questions that you may have. If you're considering getting your 65, we'll even help with the education and cracking the book, where to get the books, and how to open up your U10 all the way through working with integrating your practice. If you're not quite ready yet, but you have clients that have money within large wealth managers and you'd like the other advisor not necessarily to be in the door, we do have a program that, let me know if you're interested, to where we can actually have IAMS Wealth. Zach on our IAMS Wealth team can work with those clients directly if it'd be a fit, and even take over those assets while you're considering. Help the client and reduce maybe their fees, allow you to write the FIA business. And the only thing is we can't pay you directly for that unless you do get your 65. So once you test and get it, we can help there. But otherwise, sometimes it helps just to have that resource of somebody on the security side. So let us know if you have a question. Our life and annuity training academies, we're back this year. We're working through the event follow-ups on the last one, and we're looking at getting our schedule for next year coming out within the next couple of months. So stay tuned for that. If you have any questions or if you'd like to be on that list, please let your marketer at IAMS know. Our annual trip, we're still in the 18-month qualification period for it. Still time to qualify. 4.5 million in annuity production roughly will get you the points, and that qualification period ends December 31st. And now to Seaside Sanctuary, where we're going to be going in historic downtown Charleston. Top 20 have an extension on the trip to where they're going to be staying extra time in Charleston Place. It's going to be a beautiful trip. We're on Facebook and LinkedIn, and now I'd like to get to the meat of our presentation as we go forward here. So be patient. I'm going to get this started and share the screen and introduce to you Tom here. If it will let me pull this up.
Great. Should I get started,
Excellent.
Justin?
Oh yeah, and you're on. I can see it now. Perfect. Okay, so I'll introduce Tom. If you want to tell the audience a little bit about yourself, and I will give the reins over to you, and appreciate your time today for sure.
Sure. No, thank you very much. Again, my name is Tom Bumbolow. I run distribution and business development here at American Life and Midwest Holding. Really appreciate the time today. We're thrilled to be talking with you and telling you a little bit more about American Life and some of the things we have to offer, and highlight our partnership with Chris Coyne and Goldman Sachs on a really interesting index, and I think a carrier that is punching above its weight for sure, and offering some pretty unique products out there in the environment that we're in. So I'll quickly go through, just to give you a little heads up of what the plan is. I'll quickly go through kind of the background of American Life, just to give you a feel of what we're all about. Then I'll pass it over to Chris for a bit. He can talk about the market and Goldman Sachs Xenith as well, one of the index options within our FIA product. And then I'll take it back and go through a couple of the products that I think are relatively well positioned for the the replacement environment that we're in right now. So with that being said, we got $2.5 billion in assets under management at American Life. We were originally founded in 1960, and what it says on the page is that we were reimagined. What happened is that several of us who've kind of been working together for many years came from backgrounds on the investment side of the equation, had been involved in insurance, and were consistently getting pulled into conversations with asset managers who are also trying to get involved in insurance. So in 2018, we went out and bought and purchased American Life, which was a very small carrier that had a very limited, if any, balance sheet being utilized, and no legacy debt, no legacy transactions, and no legacy technology. So those are the things we were going after, and hopefully domiciled in Nebraska. So we've been writing business there since 2019. We're B++ at AM Best, as you can see, and we're currently publicly traded under NASDAQ. The ticker is MDWT, which is Midwest Holding, our parent company that owns 100% of American Life. So our idea here is, again, I mentioned, no legacy technology, no legacy debt. So what does that do for us, and why do I mention it on a call like this? I think that's important here because of our speed to market, our ability to change pricing, our ability to address, and focus on the feedback we're getting from you, the agents who've got your ear to the ground, and we're able to, affect change within new products, affect change within our pricing strategy, and so on and so forth in a relatively quick fashion. So that being said, I'm adding slides as opposed to going to the next one, I think. There we go. We've been growing very dramatically since we started in 2019. And when I say growing, we kind of measure that 4 ways. The number of products that we offer, we're very straightforward in that we've got, the classic MYGA and a classic FIA product. We started with a 5-year MYGA and a 10-year FIA. We now have a 3 and a 5-year and a 7 and a 10-year, as you can see. I'll go through the details of all those as we move forward in the presentation, but we continue to offer, new and innovative products with the Fusion that we just launched in June that we're very excited about. Geographically, when we took over American Life, I believe we had 9 state licenses at the time. So since then, we've continued to expand, and very happy to say that after a lot of effort last year, we were able to reap the rewards of that effort, and got 5 new states so far this year, which are listed below. We'll continue to focus on state expansion. But the point I want to make here, I think, is a relevant one, and it goes back to what I said earlier about punching above our weight. In 2022, we wrote $715 million in written premium. And that's across 22 states, right? So that was without adding any, the prior year we had written about a little over 400 million. So that growth was achieved without adding any IMOs, without adding any new products, and without adding any new states. So if you parlay that 715 across a complete geographic footprint, which we hope to have sooner rather than later, that's about a $2.2 billion run rate. So it's great to write a lot of business and it's great to be expanding, but we need to be able to handle that business. Huge issue within the market, that we're all dealing with. That being said, our service has continued to improve and we're building it to scale not only our volumes today, but what we plan to do in the future. So we've got a new head of operations with over 20 years experience. We just hired a new chief information officer, doubled our staff, launched a conversion program for the Roth. We continue to work on our agent portal, and there's a number of other things we're doing as well. But I just want to make a note here that we're very focused on that as well, and that, I view it as two sets of clients, right? Our clients are you all, the agents that are, choosing whom to do business with, and we're fortunate that you're giving us the time today to even consider us. And then the clients, right, that you speak to every day that are trying to find the right products to meet their needs in retirement. So we want to continue to enhance that experience and make ourselves as user-friendly as possible. I mentioned earlier, a limited state footprint. So right now we're sitting at 26 states if you include DC. Again, got Florida, Georgia, Kentucky, North and South Dakota, all this year. All started around, I believe it was April or March when we started getting those in. So we're thrilled about that. We're, trying to get our feet on the ground in all those states and look forward to kind of continuing to expand there. We've got, again, I mentioned earlier, and I'll go into more detail, but before I pass it off to Chris, which I'll do after this slide, we've got, again, 3 straightforward products. If I were trying to write a cheat sheet on American Life as to what to focus on, we've been in the top of the pack in the 3- and 5-year rate on the MYGA space for the past year and a half. Plan on continuing to be aggressive there. I think our model in that we reinsure 60 to 90% of the premium that we write with third-party asset managers. That allows us, the only reason I bring that up is that allows us to be competitive despite market conditions. So we're investing in a number of different asset classes and utilizing an open infrastructure or an open architecture to have access to some of the best-in-class institutional asset managers out there. So, the example I like to give is that if we were just involved in, let's just say, private credit in 2022, there would be no way we'd be able to compete in the pricing war that was going on out there. But we were able to, and with the help of IAMS and a few other partners we have, we're able to compete and thrive. So, I think the market grew by 100%. Our MYGA volumes grew by 250%. Our FIA, again, one simple product. I'll go into more detail when we get through Chris's part, but again, one product, one chassis, 3 different options. And then Fusion, we're totally excited about, and I'll get into that in a bit soon as well. But that's American Life. Again, very simple, very straightforward, trying to be as user-friendly as possible, and focused on trying to grow our presence out in the marketplace and get the feedback that is so critical for us from you all to make our products, stand out and fit for the needs of our clients at the end of the day. So I'll take a quick pause here. Justin, I don't know how to pass it to Chris. I think you might need to do that for me, but I will take a quick pause and let Chris take over, if that's okay.
Absolutely. No, I appreciate it, Tom. I'll get you switched over. And I would second the comment you made about, and very happy to see the launching of the Roth conversion program, which I got to say, from a distribution standpoint and working for one of the major carriers out there for FIAs as long as I did, that's it's kind of unheard of. A lot of the insurance companies that I may name, I'm not going to name, bigger carriers may have turned down even doing a Roth conversion process at all. And it speaks to your enhancement to your operations side and your value to the agents. Much appreciated. Okay, this should be switching over here. Just let me know when you get it there. Okay, so here we go, Chris. And I'll tell you when we can see your screen. Perfect. You're a go.
Just going full screen mode there. Well, thanks, Justin, and thanks, Tom. Appreciate you guys having me on today. The partnership with American Life and even IAMS has been fantastic for me. A little bit of background on myself. I sit on the trading floor in our New York office, so I'm amongst the quants who design the indexes on these FIA products and the traders who hedge the options on the index. So I get a firsthand look under the hood of how the volatility control indices work. And I want to give our team some credit, as this past year, we won Best Hedging Provider among all the investment banks globally, and we won Best Quantitative Index. And you'll see in a few minutes that we've got a really unique index here with American Life with the GS Xenith Index. So back to that first award on the Best Hedging Provider, I want to spend a few minutes on why that matters. Well, we're able to execute efficiently and get the best pricing, and in turn, that translates to a carrier being able to offer the best par rates to your customers. And I think it'd be helpful to give some context on why you're seeing the participation rates on vol control indices so high right now, especially relative to the last few years. So over the past 18 months, the Federal Reserve, they've embarked on quantitative tightening, which is essentially raising interest rates to combat inflation, because if money costs more money to borrow, then in theory, people should be spending less of it, and in turn, less money circulating the economy. So that's proven to be the case as we went from near zero interest rates in 2021, start of 2022, to over 5% today. It was the fastest rate hike in recorded history. And during that time, we were able to bring inflation down by half of what it was, about 9% last year, 4.5% now, but we still have a ways to go. Now, a rising interest rate environment, that's generally a negative development for bond investors because of the inverse relationship between bond yields and bond prices. So when yields rise, the price of bonds already in the market will fall. So let's take a 10-year treasury bond. That could lose approximately 10% of its value if interest rates rise by 1%. Now in 2022, 10-year treasuries during that rate hike period were down almost 16%. However, an issuer of a principal protected product like an FIA, should see the terms that they can offer become more attractive as interest rates rise. So when interest rates rise, asset yields on the investments usually do too, which means insurance carriers, they have higher hedge budgets and they can offer more attractive terms. So when American Life sells an FIA, they invest the proceeds into a investment to match the duration of a contract. So 7-year product, they'll invest in 7-year maturities, 10-year bonds, et cetera. And these are typically in highly rated corporate bonds, but as Tom talked about more recently, some alternative investments in there, getting those higher yields. And with that, then they go to the investment banks like Goldman, and we go and buy a basket of options on an index. And as the asset yield is expected to increase, which it has been in the last 12 months, that leads to more money left over to purchase options, and those dollars can buy a lot more options, hence the higher hedge budget. However, a higher hedge budget, it doesn't necessarily translate to more attractive terms. A big component is the volatility in index option costs. So as volatility increases or the risk-free interest rate moves, so does the cost to purchase options. Now, the traditional S&P 500 been very volatile through the tumultuous markets of the last few years and the rate increases, while a 5% volatility control index, or any volatility control index for that matter, provides more stability from a hedging perspective. Now, this stability allows insurance carriers to offer better rates on vol control indices since you know what the cost of the options are going to be consistently. And Goldman Sachs, we believe that we're going to be in a higher interest rate for longer environment You know, despite inflation coming down, it's still running hot and not at the Fed's 2% target. So we think maybe there's one more rate hike on the horizon in the next couple of months, but we don't see any cuts. So we think we're going to be north of this 5% target for the foreseeable future. So this leads me to talking about the environment we're in right now, and it's one that's materially different than the other cycles we've experienced over the last few decades. If you look here on the screen, you know, previous environments, they talk about the traditional investment cycle, pre-1980s. That was more boom bust. And then post-1980s, there was a lot more stability in markets until about 2020 when things started to go a little haywire. But it was a more stable environment. But what we feel we're in now, and Goldman has coined this term, the new postmodern cycle. It's going to be defined by persistently higher interest rates and inflation, the regionalization of supply chains or onshoring of manufacturing. Think about the chips manufacturing going on in Taiwan that they're bringing to the States now. It's going to require more expensive labor and commodities as well as we embark on the decarbonization and electrification of the world. Those require precious metals. So, you know, we were very thoughtful when we worked with American Life in the design of the Xenith Index, taking all of this into account and having the right tools in the toolkit to be able to weather all types of environments and not just one that sells on the last 10 years. So at its core, you'll see here at the bottom of the page, the Xenith Index is a rules-based strategy, gives you a diversified portfolio, U.S. equities, 20-year treasuries, copper, gold, and a proprietary commodity curve strategy inside of it. And it targets that 5% volatility target. Now, at the end of each month, the index determines a growth signal based on economic activity. The growth signal will either be 0, potentially indicating a decreasing growth environment, or it will be 1, indicating an increasing growth environment. Now, the growth signal we use is the Conference Board Economic Leading Index, and that takes into account 10 indicators such as manufacturers' new orders, building permits for new homes, average consumer sentiment as well. And so we use this to set allocations because although what happened in the past matters, we believe you can only get so far driving a car while looking in the rearview mirror and following the yellow lines behind you. So we believe that forecasting over the next 7 months in the business cycle is a more appropriate way to set allocations. So when the signal is flashing rising growth, we'll allocate more to equities and copper. And in a decreasing growth environment, we'll get a little bit more defensive and go to fixed income and gold. Now, regardless of the growth regime, the basket is always going to provide a constant exposure to the commodity curve. Go to the next page here. You know, that commodity curve strategy, it's what we would label an alternative long-short investment. And Goldman has typically reserved these types of strategies for ultra-high net worth and institutional investors. Yet here we are offering it as a sleeve inside of a product that's available to end clients in a principally protected product nonetheless. So this commodity curve strategy, we look to arbitrage commodity contract prices at different points in time as opposed to the commodities themselves. And that can, being long short, can lower the overall volatility of the index and also generate some uncorrelated returns. So this last piece I want to touch on is the diversification of the index matters, but more importantly, diversifying among crediting strategies, that's proven out to be prudent over time. Now, in this industry, I know we like to beat our chest that 0 is your hero, but we believe it does not have to be. If we can limit the number of zeros in any given year, it's not only a better client conversation, but you allow the power of compounding to take hold. If you look at the S&P with a 7.5% cap over the last 15 years, which I understand lower than the current environment, but directionally accurate, you would have had an average 1-year payout of only around 5.5%, with a almost 1 in 5 chance of ending up with a 0 in any 1 year. However, given the ability to have the outsized par rates on the Xenith Index that I talked about, your average 1-year payout would have been greater than 10%, while reducing the chances of a 0 payoff to less than 10%. Now, that's the power of a diversified index that can weather the different environments while being able to offer outsized returns due to the index design. If you want to diversify even further, pair the S&P with a, another vol control, Mark V, for instance, and Zenith, and you give a little bit of upside, you give up a little bit of upside, not much, but you bring your frequency of 0 to less than 5%, given the different return profiles of the indices and how they perform in different market environments. So volatility control indices that are thoughtfully designed like Zenith and can provide more certainty around outcomes, which in the years in and around retirement are critical. So know I threw a lot at you there. So just to recap, what's most important with the GS Xenith Index? One, you're getting a well-diversified index across equities, bonds, commodities, and an alternative strategy that's built for the next 5 to 10 years and not built just to optimize a backtest. You've got forward-looking signals that set allocations based on the road ahead, so we can be a bit more nimble. And while it's exhibited strong raw index performance, the benefits of outsized participation rates can offer higher returns than the traditional S&P while limiting the frequency of 0 in any one year, which in turn provides better client outcomes. So I hope that was helpful. I want to thank you all for the time today. I know Justin's going to field some questions and happy to help answer them as need be. But Tom, I will stop sharing my screen and kick it back over to you.
Excellent. Great. Thank you again, Tom. Go ahead. This is I'm going to switch over the screen here, but go ahead.
Great. Thanks again, Chris. That was fantastic. I mean, that one of those last points you made, being able to offer your clients an index option where you decrease the chances of a 0 to less than 10% is very, very powerful. And obviously we've been in an environment over the past 6 months or so where some of the more traditional caps and pars, traditional indices have been in favor. I can tell you from our perspective that Zenith has been a very, very popular option. So we're thrilled with the partnership in this business, especially the way we've set ourselves up. We are only as good as our partners, and we're thrilled with IAMS and Goldman. It's been fantastic, and we're looking to just build upon everything we've built so far. So I'll quickly go through the products here right now with you guys. What you'll see is there's 3 kind of trends here. They're simple, they work for all the necessary stakeholders, and there's consistency. So I don't, Justin, can you see my screen now? Is that up and running again?
I think it's recycling. Give me 1 second here.
No problem. I'll get started on the MYGA while Justin's setting that up for us. But the MYGA, the shtick with our MYGA is basically it's 2 in 1. So we don't think it's fair to ask the client to choose between liquidity and yield at the time they're writing the policy. So we've kind of embedded 2 options into one product. We call it, go. How are we doing? All good now?
We are good. Go ahead. Thank you.
Awesome. So you'll see on this our American Classic, that's our MYGA, you'll see 2 rates on here. You'll see the guaranteed rate. If you look at the 3 years right now, it's at 525. You see something called an enhanced interest credit, and then you see an effective annual rate of 540. So what that is, that enhanced interest credit is a loyalty bonus. If you stay within RMDs over the 3 years that you have the policy out, you get that bonus. You don't have to decide today. If in 2 years we get hit with COVID too and things come up and you need the additional liquidity above RMDs, you can take it. You're going to get the guaranteed rate, the 525. But if you don't need the liquidity and you leave the capital in, you can have RMDs, as pointed out on here, and you'll get this bonus, this 45 basis points. So the difference is just 45 divided by 3. You get 540, same thing in the 5 year. You're getting 530 or 542. So what we've been told, and the reason we structured it this way is, this is the kitchen table sales, embedded sales option, right? You don't know when you're going to need the money. You don't think you're going to need the money, but you never know. Some products make you choose day one on liquidity. Again, we don't want to make the client choose day one. We realize we need to be flexible as we can be. So we've embedded both of those into one product. So if you look at Annuity Rate Watch, you'll see us listed twice. The way they list us is no liquidity and liquidity. That's basically the RMD version on top, right, with the enhanced interest credit, and the level below is the guaranteed rate, which means you would take liquidity above RMDs. So I've included this just to show you, I think this is a screenshot as of July 25th, but we've kind of been on the top of both the 3 and 5 year pack for the past year and a half. Continue to be, looking to stay in that general area. So that's been a huge win for us so far. Again, it's got to work for all the stakeholders. So we've included our commission grid as well, so you can see EAPs versus paper. If you write an EAP, you get an extra 25 basis points. So a 5-year MYGA paper, we're paying 225 right now. If that's submitted EAP, a Firelight, you got 250. I think our, the age breakdown is here as well, and we're going to share all of this stuff with you as well in the end. So don't feel the need to scribble anything down. We're going to share all these materials with an email from Brooke and I at the end of the presentation. To move on to our FIA, our thought process with our FIA is, when we were going to all of the conferences in January that were being held with the various IMOs that we're partners with, which aren't too many, there was one consistent theme, and that was, rates have moved, as Chris pointed out, the most dramatically and with the most velocity that we've ever seen before. So there's a lot of business that's sitting in your general book of business that was written a year or two ago that might be sitting there at a 7% cap, which at the time was phenomenal. We're in a different environment now, right? You're seeing 11s, you're seeing, very, very aggressive pricing, fixed rates above 5, so on and so forth. So every IMO that we partner with was basically kind of encouraging their agents to go around and look at not only new business, but look at their existing book and identify, opportunities to put their clients into, a better position than they were several years ago. So that being said, we've really focused so far this year on our bonus and our bonus plus product. So we've got our base, which is down this column here. You've got our bonus and then our bonus plus respectively. So base is self-explanatory. Right now we've got a 5% fixed rate, we've got an 11% S&P cap, and then the Xenith, which has been selling very, very well for us as well, the 1 year at 200 and 275 for the 2 year. That gets you 10% liquidity in year 1. The bonus and the bonus plus are obviously, more geared towards clients that are looking for potential replacement. And we've increased those rates, as you can see. So for our bonus, we're paying 12 and our bonus plus 18 currently. So I think that's close to, if not the top of the market. You've got the crediting rates going down below. The main difference between the bonus and bonus plus are, 1, liquidity. You'll see you get a little bit extra liquidity in the bonus plus than you would have in the bonus, 10% in year 2 as opposed to 5%. The other thing you get is very much akin to the loyalty bonus that we discussed in the MYGA. You get an extra 3% on the accumulated contract value at maturity if you stay within RMDs. So that is massively valuable. There's a charge for the bonus plus, 80 basis points annually. So base, straightforward, 5%, 11. You see the Xenith rates, liquidity in year 1. Bonus, 5% liquidity in year 2, fantastic bonus rates. No bonus at the end of the contract term. And then bonus plus, you get that 3% kicker on the accumulated account value and a little bit better liquidity, but you have to pay for it. So very simple and very straightforward, but I think, one area that I wanted to spend some time on to make sure that folks were aware of, especially in the environment that we're in right now, I think that 12 and 18% bonus numbers stand out very strongly. Our index options, again, kind of listed them, in not only importance, but I think what we've seen in terms of popularity as well. We've been in a conservative environment. We've seen a lot of allocations to fixed rates and to S&P cap rates. I think we're finally starting to see the trend buck, and we're starting to see clients, come off that conservative nature and start to, remember, if you will, the value of diversification that Chris talked about, going from, 10% chance of a zero down to a 5% chance of a zero. And then again, fixed rates being where they are has been a very, attractive place to, hide capital, if you will. When I say hide, just hang out for a year and then kind of decide down the road what things are going to look like. Again, that trend has changed a bit over the past month or two, and we think the values of diversification will continue to kind of, make themselves, obvious as we move forward. Has to work for everybody, right? So agents were paying 7% on the 10-year and 5.25% on the 7-year. I think that's very aggressive, in line with the market. And again, it's got to work for us. It's got to work for you all. It's got to work for the clients. But lastly, and I think very importantly, is we launched our enhancement program this year. I think most carriers have one. This is the first year we've launched one. The important part that I'd like to focus you on for this is the low thresholds, right? So we're going to continue to grow at the rate we're growing at, if not faster, by one, writing more business with our existing partners, and two, getting agents from our existing IMOs to take the chance on us and start writing American Life as well. So you can see you only have to write $300,000 of business and you have a 50% commission enhancement. That's paid at the end of, or the very beginning of next year. So it's paid annually. And I think, again, the thresholds were set relatively low on purpose, because we know we're a new name. We know we have to earn your trust and your time. So we wanted to set up a program that was akin to and brought us to parity with the market. But we also wanted to set the thresholds at a low level to get a chance with some new agents as well. Last, or almost last, I would say I'll go to Fusion. Again, I said simple works for everybody and consistent. So I'll get to the consistency part right after this, but simple doesn't get much more simple than Fusion. So Fusion sits right between a MYGA and a FIA. We like to call it a MYGIA. You get the 4% guaranteed rate for 5 years, and you get some upside, right? If the S&P index grows by 25% between now and 5 years from when you wrote the contract, you get a bonus of 14% on the accumulated account value. That would take the effective yield to 676. Very simple, very straightforward. No indices to choose from, no par rates, no cap rates, no vol control indices, no complexity whatsoever. This is a binary outcome. You're getting 4 or you're getting 676. End of story. We think this is an attractive product for MYGA clients that are looking for some upside, that are thinking about a FIA. We think this is also attractive for traditional FIA clients that they've all been running towards the MYGA space because of the conservative nature that's out there. This allows them to lock in a 5-year guaranteed rate while still having some upside. Last point I like to make on this slide as well is, in the environment we're in, thank God we're not subject to this, but there's been a lot of conversation about renewal rates and some of the behavior out there. This product has no renewal rate risk, if you will. So clients that have been burned by that or are weary of that, this is a beautiful solution to that sort of problem as well. So you get the guaranteed growth of the 4%, and you get the chance at some upside as well. The next question that usually comes to mind is, what are the chances of that upside? And I would say this slide highlights it perfectly. We looked over the past 10, 20, 30, 40 years. And as you can see, you've got, greater than a 75% chance of getting that higher yield, that 676, according to everything that's happened in the S&P over the past 40 years. So you can look at the timeline that we've got. The past 10 years, it would have been close to 95% of the time you would have gotten the higher rate. Go over the last 20, 30, all the way back to 40. Again, I really want to stress the simplicity. Binary outcome, 100 grand. You're either getting the 4% on that 100 grand, the compounding, right? So this is not simple interest. This is guaranteed compounding interest, which would take you to about 121,665. The S&P 500 is 25% higher in 5 years. You get an extra 14% on that accumulated value. That takes you to 138, is where we get our 676. The S&P has not accumulated by 25%. You still get the 4%, and we move on. Again, simple, straightforward, and soon to be consistent. Has to work for everybody. Well, again, here you go. We talked about our commission rates for our FIA product, 5.25 on the 7-year FIA with all the index options, so on and so forth, the bonus plus, 7% for the 10-year. You compare it to our 3-year MYGA, which is at or close to the top of the market for commissions at 150. We wanted it to make sense. So you got 3% for EAPS on Fusion, 2% for ages 81 to 90. So again, something extra, considerably larger than what you're getting in the MYGA space. Not as complex, and quite frankly, no margin to pay anywhere near a FIA type level. But we wanted to make it make sense for agents to focus on and give a great product solution and choice to our clients that are out there right now. A focus on simplicity that made sense for our agents to focus on as well. So we're really, really excited about this. Getting a ton of traction. We've been covered in many of the news articles and the sites out there. We can share some of that as well when we send around the materials. But Fusion has been very popular since we've launched it and continues to build momentum in sales as well. I'll wrap things up just quickly with 2 other top topics that I think are relevant and speak to the consistency angle that I mentioned earlier. One, I'll talk about renewals. It's very nice, and I'm thrilled to be able to put a slide up here that shows 100% renewals. I do want to make the caveat that we've only been writing business since 2019, so it's relatively easy to be saying that. I'd feel much stronger about this piece if it was over the past 20 years. So let's be honest. But at the same time, this is the theme and what we're committed to trying to provide going forward, and we're very proud of what we've been able to do so far in the renewal space. This piece will be made available to you in the email that we send afterwards. And then lastly, suitability, hot topic. If we're talking about potential replacements, we're looking at bonus products, we're looking at products that have no renewal risk. It's something that clients are very concerned with. So we just put out a brand new suitability guide. It speaks to a lot of our liquidity requirements. I would roughly give you, for liquidity, 65 and older, we typically look for around 18 months. 64 and younger, we typically look for about a year. In terms of, allocations to illiquids, nothing more than 80% seems to be our general. These are generalizations. There's obviously a lot of things that go into our decisions around suitability. That being said, we want to make it easier for our agents. So along with the guide that we're going to send you after the presentation, we also have a pre-qualification form, right? So if you're trying to figure out, you've got a large case, you've got a tricky case that you're not really sure about, you want to get a quick answer, we've got a form you can fill out relatively quickly, shoot it over, and get a very fast answer as to whether or not this would fly. So that's basically American Life. Sorry if we ran over a little bit. As I mentioned, you're going to get a bunch of marketing materials from us when we coordinate with Justin after this, but we've got all sorts of things, that Roth conversion flyer that we'll send around, client guides and brochures, all sorts of information, and looking for feedback and looking for the chance to work together, and we're thrilled with the opportunity today. And we're looking forward to growing together. So I appreciate the time, and it's very, very fortunate of us, and we're very lucky to be able to be partnering with Chris and Justin at Goldman and IAMS. So thanks again. I appreciate the time, everyone. Any questions?
Thank you, Tom. And I'm going to post if we do have any questions for either Tom or for Chris or myself or IAMS, please funnel those questions. Feel free to funnel those through me, Justin at IAMSinc.com, or your primary contact at IAMS here as we begin to make follow-ups. Really a breath of fresh air to be partnering and more of a confirmation of being in line with the same philanthropic beliefs with you guys at American Life, Tom, and in Goldman Sachs with Chris. Just mentioned there, I'm starting to see more conversations around, as an example, using two of the products together in a design. Quite simply put, there's no reason today, no one's told us that we can't use conditioner and shampoo in two separate bottles and mix the two together to make something that we need. And, thinking of that, I'll probably come up with a better analogy, but basically you've got an opportunity, perfect storm, replacements, an opportunity to get a client reset into a product that is priced for today, at a higher rate, but then at the same time using the fusion. If we know that in 5 years we would like two outcomes, one that we know we're going to have at a worst case, which is the 4%. Two could be an excellent, or will be a 76% chance to get a 14% account bonus in 5 years. I can tell you two things that I like about that. In 5 years, I know that I have an opportunity to get paid again as an agent potentially, whether that's dollar cost averaging out of that 5 year into something else, moving it to even a bank or another annuity, or with American Life maybe. But I also know that I'm not walking into a difficult conversation because, again, they got the 4%. It may be a winning conversation as they get the 14 on top of it. So I'm liking to see these designs. It tells me the field's looking at it. Appreciate your help, American Life and Goldman. So I'm going to go ahead and ask a couple questions here so we can get you guys everything. As Brooke and Steve mentioned, or excuse me, I'm looking at two names. As Brooke and our team mentioned, they're going to be getting this out to you, or Brooke will be emailing it. Do you know if that'll come underneath Brooke, Tom, under her signature? Or
Yeah.
okay.
Yep, Brooke Meyer, absolutely.
Excellent. So appreciate that help. I will get you the list of attendees, and then here are some questions for those of you on the line here. If you'll answer these for us, I appreciate it to help us better get back with you some information here. So first polling question on the screen here as you begin to answer those in the audience is going to be, would you like to appoint or license, get access to American Life's products and the limited distribution product, the MYGIA Fusion, if you're not already? And we'll get that link through SuranceBase sent over to you to get you set up. Appreciate that here. And as we continue to wrap up here, we'll close that out. The link will come from contracts at SuranceBase, and then you'll have communication, of course, from all of us here and your primary contact. I appreciate that. I'm going to go ahead and close that one and start the next one. Okay, so next poll. For those of you who have not attended and are interested in and would like to attend a training event, one of our IAMS education academies for life and annuities, like I mentioned before, we're looking at our schedule and how we're going to address the great input that we received from the last one that went off with a great success as far as advisors signing up and getting a part of a marketing program or rubbing elbows, sharing ideas. So if you want to be part of that, let us know and we'll get you on the list. What we don't have yet is dates. So we'll get back with you on that as we get the schedule all set up. So appreciate it and getting you on there. And then we will be back and we wrapping up that poll question. We'll go on to the next one here. Thank you. Any of the products that we discussed today or concepts at this point, do you believe that it'll meet the needs of your clients? Now, this is kind of big picture. Like, does everybody like money? Yes, the answer is yes. Bigger picture, would it fit any of your clients and would it be a benefit for us to reach out to you to go ahead and put together a design, illustration, example or concept like we talked about? If you're looking for something unique or particular, how we could pair two of these products up and make a solution for the client. If anything like that comes to mind, or even if you just want to see an illustration, some people want to see those, we can do that for you too. Just let us know and I appreciate it. And then final polling question, would you like more? See, we're in the middle of the year. Would you like to hear more about the various appointment and lead generation programs that IAMS has put together? Again, input from all of our top advisors, who they're using, what they're using, why it works well, and in some cases of webinars highlighting those advisors and what they feel about these programs. It's mid-year. I've talked to a lot of folks over the last couple of days about what they're doing in their marketing plans, adding additional workshops, reducing them. now's the time. So we'd be happy to have those conversations. Talk to your primary contact here, or let me know, Justin and IAMS. Be happy to speak with you about getting in front of more people to help with these products. Tom, Chris, Brooke, everybody out there, appreciate your time, and we'll be talking to you soon. Thank you, Tom. Thank you, Chris. Brooke.
Great. Thanks so much, everyone.